All Vanguard ETFs are just a bunch of letters that won't mean anything to most people. So today, let's go through all 30 Vanguard ETFs that you can invest in Australia. And let's start with the domestic ETFs. Number 1, we have VAS, which is Vanguard Australian Shares Index. It's an index fund that tracks the top 300 company stocks on the ASX. Even when the company's rankings adjust and change, VAS will consistently rebalance its holdings to ensure that you only get the biggest 300 companies. VAS charges a management fee of just 0.1%, which is the third lowest fee in the entire 30 product list, and a great place for all Australian investors to start, returning 9.6% per year on average in the past 10 years. Number 2, we have VLC, Vanguard MSCI Australian Large Companies Index. It's similar to VAS except that it only holds 22 of the biggest companies on the ASX, which means that on the ASX, it's mostly investing in banks, miners, and healthcare. Its management fees are double of VAS at 0.2% and return 9.5% average in the past 10 years. At number 3, we have VSO, Vanguard Australian Small Companies Index. It's the other end of the spectrum, which invests in 200 small cap companies instead, and is designed for investors with a bigger tolerance for risk. Its management fees are higher again at 0.3% and return only 7.7% a year over the last 10 years. At number 4, we have VHY, Vanguard Australian Shares High Yield. It's focused on companies with a higher dividend payout and is suited for long-term investors looking to reinvest all dividends and use the power of compound interest, or just live off the income every time it pays out. Performance has been decent over the last 10 years, averaging 9.9% return annually, but its management fees are high at 0.25%. At number 5, we have VAP, Vanguard Australian Property Securities, is an index fund of REIT shares on the ASX 300. So companies like Goodman Group, Scentre Group, Mirvac Group, and so on. It actually pays similar dividends to VHY, but with a slightly lower management fee at 0.23%. Performance is also better than VHY at 12.6% return annually over the last 10 years. At number 6, we have VETH, Vanguard Ethically Conscious Australian Shares. It's a fund that excludes any companies that produce fossil fuels, alcohol, tobacco, gambling, weapons. You get the idea. So it is essentially VAS, which holds the top 300 companies, except that around 50 companies have been excluded, and because of that, it needs a bit more management. You'll pay higher fees than VAS as well at 0.16% compared to just 0.1%. It hasn't been around long enough to know its 10-year average, but its year-to-date performance is around 1% lower return than VAS. The next 3 ETFs are all government bond ETFs, which are super safe but very low in returns. These are VACF, VAF, and VGB. I wouldn't ever consider these because the management fees are the same as all the regular ones, but the returns are only around 3 to 4% per year at best. Let's get out of Australia now and go to the US. At number 10, we have VTS, Vanguard US Total Market Shares Index. This holds a portfolio of almost 4,000 US companies including Microsoft, Apple, Google, Amazon. So technology stocks make up the biggest proportion of this portfolio. It's also got the lowest management fee that I've ever seen at just 0.03%. So for a $1,000 investment, you only need to pay 30 cents, which is absolutely amazing value. It's also got the best performance of all Vanguard products as well, returning almost 20% per year on average in the last 10 years. One thing to note is that the price to earnings ratio is a little bit high, but I still wouldn't be betting against the US economy. Now, let's head over to Europe. At number 11 is VEQ. Vanguard FTSE Europe Shares is a European equivalent and holds around 1,300 company stocks. For whatever reason, its management fees are almost 12 times the US version at 0.35%, but its annual returns are only half of the US. Still, it's available to invest if you want to hold companies like Unilever, BP, and even AstraZeneca. Heading over to Asia, and we have number 12, VAE. Vanguard FTSE Asia, excluding Japan Shares Index, is the Asian equivalent and has around 1,400 different companies in the Asian markets. This Vanguard product has one of the highest management fees at 0.4%, but has a relatively low price to earnings ratio. I'd say its performance is on par with VEQ, and investing in this fund will get you companies like Tencent, Alibaba, and Samsung. We're almost halfway, but now let's go global. The next 4 Vanguard ETFs are all investing in other ETFs rather than holding companies directly. So you can see, for example, that VDHG mostly holds VAS and VGS, and then within those funds holds the company shares directly. The 4 of them are all like that, just with different proportion allocations of income asset classes and growth asset classes. Income asset classes basically include things like government bonds and cash investments. This asset class generally gives you less volatility and as a result lower returns over the long term. Growth asset class is essentially any investments in shares and could even be in real estate as well. So the safest ETF with 70% in income assets and 30% in growth assets is VHCO. VDBA is a 50-50 split between the income and growth asset. VDGR is 30% in income assets and 70% in growth assets, and the hugely popular VDHG is 10% income assets and 90% growth assets, which would be my preferred allocation. That's also why it pays the highest dividends out of the 4 and has the best performance as well. The only downside is that all these ETFs management fees are slightly on the high side at 0.27%, which will eat into your returns over the long term. At number 17 and 18, we have VGS and VDAD, Vanguard MSCI Index International Shares, are funds which invest in the world's largest company, excluding Australia, and reinvests any net dividends for you. You can imagine that means it'll mostly hold US stocks, with some European stocks as well. The difference between VGS and VGAD is that VGAD is hedged into Australian dollars, meaning that you won't be affected if the currency rates fluctuate. And so, because of that, VGAD charges slightly higher management fees at 0.21% compared to VGS's 0.18%. Performance-wise, they average around 13 to 14% return annually with minor currency variations. At number 19, we have VEU, Vanguard All World Excluding US Shares Index. If you want to invest in a global ETF that invests in the biggest companies in the world, then it's going to be very US heavy. That's why VEU was created to exclude US companies in its fund. It charges a very reasonable 0.08% in fees, but its performance suffers at only 10% return a year on average over the last 10 years. At number 20, we have VGE. Vanguard FTSE Emerging Markets Shares is the most expensive to invest in with a fee of 0.48%. This fund invests in emerging markets like China, Taiwan, India, and Brazil, and has returned around 8% annually since its inception. But this fund banks on those companies' economies surging ahead in the long term. At number 21, we have VBLD, Vanguard Global Infrastructure Index. It's the second most expensive Vanguard fund and gives exposure to 136 listed infrastructure companies around the world, even if it's very US heavy. These are things like energy companies, railroads, pipelines, and infrastructure REITs. This is only a very new ETF, but it has been doing well, returning around 14% per year. At number 22, we have VISM, Vanguard MSCI International Small Companies Index. This one is pretty self-explanatory. It's investing in all the small companies in major developed countries again, with an emphasis on North America. It excludes Australian companies and reinvests all net dividends with a pretty high management fee of 0.32. It's only a very new fund, but is already at 15% return average annually. At number 23, we have VESG, Vanguard Ethically Conscious International Shares. It's similar to the Australian version for the Ethically Conscious VETH, but is for international shares and excludes Australian stocks, as well as any companies involved in fossil fuels, alcohol, tobacco, and gambling. The management fees are also a little bit higher at 0.18%, but is still a good performer so far at 15% return since its inception. At number 24, 25, and 26, we have VMIN, VGMF, VVLU. These 3 Vanguard products are its actively managed funds, meaning that the fund managers regularly open and close positions in holdings based on their stock evaluations. In other words, they regularly look at whether the stock is worth holding and change portfolios based on company performances. VMIN is designed against volatility by holding the most minimal of risky stocks, hedged against the Australian dollar. It has a fee of 0.28% and has returned just 7.4% annually since its inception. VVLU charges the same management fees as VMIN, but trades minimum volatility for undervalued stocks. It has underperformed though, with only a 7.7% return annually since its inception. And finally, VGMF charges a 0.33% management fees and invests in stocks based on 3 main factors: momentum, fundamental quality, and value. Does that work? Well, historically it has returned 10.6% since its inception, and it hasn't been around long enough to know if it will outperform an index fund. At number 27, 28, 29, and 30, we get to the last 4 Vanguard products, which are all bond and security index funds that invest in income securities issued by governments from around the world. These are VCF, VIF, VEFI, and VBND. They charge management fees of around 0.2 to 0.3%, and because they are low risk, only generate around 3 to 4% returns annually. So there you have it, that's the 30 Vanguard products available on the ASX. There are also plenty of other providers of ETFs like BetaShares, iShares, and VanEck. But Vanguard has such an impressive diversity of ETFs that they pretty much got most styles covered. Anyway, if you enjoyed that video, be sure to leave me a like and subscribe to the channel if you want me to cover more ETFs like this. Until then, thanks for watching, and as always, I'll see you in the next video.